Welcome to the debate. Today we are diving into the really dramatic recent move from VerifyMe Inc., or VRME, following the announcement of its strategic merger with Open World. The market reaction was, well, swift and intense. The stock rocketed up nearly 58% on January 5th, 2026, and it instantly pulled the company out of a pretty significant regulatory crisis.
And that sudden surge is exactly why this discussion is so critical. We have to figure out, does this merger represent a genuine, a transformative realignment toward high-growth digital assets? Is it really leveraging VRME's authentication tech? Or is this fundamentally a high-risk, speculative maneuver designed to kind of obscure these severe systemic financial and operational weaknesses that have really defined this microcap's existence?
I would argue that this strategic merger fundamentally changes the entire valuation thesis for VRME. It is not just an escape plan. It's a calculated, necessary transformation that repositions the company for the future.
And I'm going to contend that the company's deeply ingrained financial instability, coupled with chronic operational failures, means this merger is an extremely high-stakes bet. It's rooted entirely in news momentum, not in any verifiable operational success or stable financial footing.
I see why you rely on those historical figures, I do. But let me give you a different perspective on the immediacy of the strategic benefits. This open-world merger is highly synergistic. It instantly shifts VRME's focus towards blockchain and tokenized assets. And more importantly, it addressed an existential threat: the ongoing risk of a NASDAQ delisting due to the minimum bid price deficiency. The moment that news broke on January 5th, the stock flew above that critical $1 threshold. That secured temporary regulatory compliance and, frankly, stability.
Temporary is the key word there. Securing compliance with a temporary news bump, perhaps, that's a fragile foundation for any kind of long-term valuation.
But the structural value is apparent. VRME's core technology, brand protection, anti-counterfeiting features like Verify Inc. and Rainbow Secure, they're integrated perfectly with Open World's expertise in blockchain, digital asset tokenization, and consumer analytics. This creates a powerful, integrated security ecosystem. It moves the entity away from low-margin physical logistics and squarely into high-margin digital identity solutions. And look, let's not ignore the balance sheet. VRME holds $4.01 million in cash versus only $750,000 in total debt. They have the financial flexibility post-merger to actually execute this pivot.
I'm sorry, but I just don't buy that liquidity argument as some kind of saving grace. Let me tell you why the context of that cash balance matters. Framing this as a calculated strategic leap, it just ignores the abject financial fragility that forced this move in the first place. We are talking about a $13 million microcap company that is sinking, and sinking fast. Their 2025 Q3 performance was, well, it was catastrophic. An EPS loss of -26 cents. That's 5 times worse than the expected loss of -5 cents. Their trailing 12-month net loss is nearly $5 million. I mean, the company is chronically unprofitable.
But even within that context, the Q3 revenue did beat expectations. That suggests that while costs were clearly a problem, there was still real market demand for their offerings.
That revenue beat, though, came alongside that massive EPS miss, which just screams severe margin compression and deep operating inefficiency. That's not health. That's a failing business model. Furthermore, their core business is demonstrably eroding, with revenue projected to decline 16.5% annually. And the capital efficiency is shockingly bad. It's indicated by a return on equity of -44.1%. That's a negative return that suggests their existing capital structure is actively destroying shareholder value at an alarming rate. This 58% stock spike is purely a high-risk volatility play triggered by the merger to stave off the NASDAQ delisting notice they got just weeks earlier on December 18th.
Okay, but let's look at the financial health through the lens of asset valuation, precisely because the focus has now shifted. While that past unprofitability is undeniable, The market is pricing the new, forward-looking company. They are trading at a PBR, a price-to-book ratio of 0.8. So while the stock price is $1.07, the book value is 90 cents, suggesting the market recognizes underlying asset value that this merger will unlock and capitalize on. And most importantly, the liquidity, that $4 million in cash against negligible debt, it means the resources exist right now to fund the integration and pivot away from those historical cash burns. The financial foundation is there to enable this transition.
That's a compelling argument based on net assets. But if you consider that PBR is practically meaningless when a company is structurally incapable of translating those assets into sustainable profit, the negative price-to-earnings ratio confirms profitability is a distant hope. And we have to talk about the Altman Z-score, a critical measure of bankruptcy risk. VRME score is negative 6.17.
That is a staggering figure. I concede that.
It is more than staggering. A score this deep in negative territory is not just risk, it is screaming immediate, high-probability distress. It signals that, absent a radical lifeline, which this merger is, the company is on an irreversible path to failure. To attribute the Q3 revenue beat to strength, it ignores the fact that achieving revenue while losing that much on EPS means management has absolutely no control over costs and margins. That low ROE is just further confirmation of this operational failure.
I would argue that every one of those dreadful metrics, the negative EPS, the high Z-score, the low ROE, they're all backward-looking artifacts. They reflect the legacy burden of their former business model, specifically that capital-intensive precision logistics segment. The entire strategic rationale of the open world merger is to declare those historical figures irrelevant. This merger offers a clean slate. It resets the debt and risk profile by changing the fundamental revenue structure.
But the execution risk of declaring a clean slate and immediately delivering on a massive business alignment is astronomical. Let's look closely at the structure of the deal itself, because it tells a different story than a simple partnership. Open world shareholders are set to hold approximately 90% of the new combined entity. This isn't a merger of equals designed to harmonize two successful businesses. This is, for all intents and purposes, a de facto acquisition or a reverse merger. VRME is primarily being used as a compliant NASDAQ listing shell, with their core tech thrown in as a secondary asset.
It's an interesting point regarding the structure, though. I would frame it differently. This imbalance of ownership reflects the true capital and technological value that Open World brings to the table. And frankly, it reflects the sheer scale of the recapitalization needed for VRME to even survive. For years, VRME was weighed down by the capital-intensive, low-margin dependency of that precision logistics segment. I mean, think physical tracking, supply chain overhead. Being structurally guided by Open World allows the new management to ruthlessly jettison those cost drains and focus entirely on the higher-margin sectors that VRME already excelled in, specifically digital identity and enhanced authentication via their proprietary inks.
Structural change is one thing, but successful integration is a whole other beast. Why should we believe they can seamlessly pivot from physical supply chain tracking and ink-based anti-counterfeiting to, decentralized digital tokenization infrastructure? VRME already has a track record of poor execution, shedding key high-profile partnerships like pulling out of the Amazon Transparency Program. Furthermore, their relationship with FedEx is reportedly unstable. They've shown they can't manage existing high-level partnerships. Why should we trust they can integrate an entirely new technological framework and corporate culture?
The reason we trust it is because the pivot isn't just about technology. It's about seizing a powerful market opportunity that is supported by policy. We know the U.S. government is heavily emphasizing supply chain security and anti-counterfeiting mandates, especially for things like pharmaceuticals and high-value goods. The combined entity, leveraging blockchain for verifiable authenticity, which is a far more robust solution than paper or simple stickers, is perfectly positioned to capture this massive, regulated market. The 90% ownership simply reflects that Open World provides the necessary platform and capital to scale VRME's authentication assets to finally realize their potential within a high-margin, software-centric structure.
It might be a necessary mechanism for survival, but the path to a profitable future remains deeply uncertain. And let's talk valuation. I believe you're relying entirely on unverified future synergy. I remain grounded in verifiable empirical evidence of the company's current condition.
I'm not relying on mere speculation, I'm relying on market verification of strategic value. The stock's immediate and dramatic reaction, nearly 58%, and the analyst consensus, which places the average target price at $1.25, all confirm that the informed market believes in this strategic integration. The future value is based on merging cutting-edge blockchain technology with VRME's proven anti-counterfeiting platform, Rainbow Secure. This new market opportunity justifies the sudden surge. It's a calculated, value-driven market re-rating, not simply a random volatility play.
I'm just not convinced by that line of reasoning, because that current stock price of $1.07 is resting entirely on the hope of future synergies and the temporary relief from that NASDAQ notice. This is a price fueled by extreme volatility and the temporary psychological barrier they crossed, not by any validated operational improvements. Look at the verifiable empirical evidence. Annual revenue is expected to continue declining year over year by 16.5%. The core structural business risks that led to the NASDAQ non-compliance warning remain fully intact right beneath the surface of all this merger excitement.
But the open world deal provides the very mechanism to stop that revenue erosion by transitioning the revenue source completely. It's the opportunity to escape the legacy constraints of the old logistics model and focus solely on the high-margin revenue streams of digital asset security. This is a fundamental realignment of the core business.
It is certainly an escape, I'll grant you that, but it's one fraught with tremendous execution risks. We are talking about betting the entire company on an integration that microcaps historically struggle immensely to pull off successfully, all while the financial fundamentals, the negative EPS, that alarming Z-score, are all screaming caution.
I have to reiterate the calculated necessity and really the transformative potential of this merger. OpenWorld provides VRME a vital lifeline, integrating its strong authentication platform with the high-growth sector of blockchain and tokenized assets. This move, I believe, decisively outweighs the burdens of the legacy financial instability. It offers a clear path to market relevance and higher growth potential. The rapid market reaction and that temporary stabilization above the crucial $1 mark validate the strategic merit of the decision.
Strategic courage, perhaps, but high risk remains paramount. The sustained threat posed by VRME's severe financial fundamentals, the chronic losses, declining core revenue, and that damning Altman Z-score showing extreme distress are simply masked by this speculative high following the merger announcement. Caution is absolutely warranted. Investors here are relying on the successful, seamless execution of a massive, business-altering integration in a highly complex and volatile sector rather than investing in any current stability or reliable path to profitability.
The story of VRME is complex. It's a calculation of whether the promise of a blockchain-driven future and a completely new software-centric structure can overcome the reality of a very difficult and unstable financial past.
And whether a temporary speculative surge can compensate for deep structural instability and the high probability that this difficult integration will simply fail to materialize into earnings?
We leave it to you, the listener, to weigh the evidence and consider the promise of this fundamental realignment against the clear present risks.
Thank you for joining us on The Debate.